Form DPT-3 now extended due date 31st July 2026. So I'll explain because DPT-3 is one of the most important annual compliance requirement under the Companies Act. So many companies, they assume that this form is relevant only when deposits have been accepted from the public or the members. In reality, the reporting requirements is much wider than, because it covers several outstanding amounts that are specifically excluded from the definition of the deposit. So an incorrect understanding of the deposit rules may expose the company and its officers to unnecessary regulatory action. Few companies feel like that. So before filing DPT-3, every company should carefully analyze the nature of each outstanding borrowing or receipt as on the date of the financial year, because we are giving 31st March. So what is the purpose of the Form DPT-3? The primary objective of DPT-3 is to enable the Ministry of Corporate Affairs to monitor deposits accepted by companies, outstanding amounts which are not treated as a deposits under the company's acceptance of deposits rules 2014, and the compliance with the provisions governing acceptance of deposits. So the form serves as a comprehensive disclosure of specified outstanding borrowings and receipts. What is the applicability? Generally, DPT-3 is required to be filed by all the companies except those specifically exempt under the rules. What are those companies? Government companies, not required. Banking companies, not required. Non-banking finance companies registered with RBI, and housing finance companies registered with the National Housing Bank. So these are all not required to file DPT-3. Private companies, public companies, one-person companies, small companies, Section 8 companies are generally required. All the companies are required except those we said no exempted. Those are required to evaluate their reporting obligations before concluding that the form is not applicable. So before filing only you should check. Even for example, I'll give you private companies, so they can take loan from relative of directors. So if it is a public company, so that is the reason first before filing only you have to carefully check. So before concluding, you better check everything. So reporting is not restricted to deposits, because your excluded deposits also we are reporting here. One of the most common misconceptions that the companies having a nil deposits need not file DPT-3. This is incorrect. Even where a company has accepted only amounts which are excluded from the definition of the deposits under Rule 2, Sub-Rule 1, Class C, those outstanding amounts may still require reporting in Form DPT-3. I'll give you an example. Bank borrowings, intercorporate loans, these are all not deposits, but you have to enter all the details you have to give in DPT-3. Directors' loan satisfying prescribed conditions, these are all excluded deposits, exempted deposits, and commercial borrowings covered by the exemptions. Therefore, the absence of the deposits does not automatically eliminate the filing of the requirement. Common classification errors, I'll tell you, the majority of the compliance issues arise not because of the companies failed to file the form, because they incorrectly classify the receipts. Some practical situations requiring careful examinations, I'll explain. Directors' loans, because the loans received from directors are generally excluded from the definition of the deposits only when the prescribed declaration confirming that the funds are not borrowed by the director, and this is only director own funds, that declaration shall be there, and then it is exempted. So loan from director, exempted deposit. Failure to obtain the declaration may result in a loan losing its exempted status. So that declaration is a mandatory. Loans from relatives of the directors. See, the treatment differs between private company and public company. So we have to carefully see. A company should not automatically assume that every loan received from a director's relative qualifies for exemption. So these applicable provisions must be examined carefully based on the type of the company, whether it is a private company, public company. You have to see loans received from LLPs, you have to check, or partnership firms. See, many companies incorrectly consider those borrowings as intercorporate loans. Exemption relating to intercorporate borrowings generally applies to only to companies loan received from another company, so not from partnership firm. Consequently, borrowings from LLPs or partnership firms require a separate examination before determining their treatment. Even share application money, if you see, share application money generally enjoys exemption only when the statutory timeline for allotment or refund are complied with. Otherwise, deposits. If shares are neither allotted nor the money refunded within the prescribed time period, then the amount may assume that the character of deposit. Yes, it may become deposit. Advance from customers. This is very important because business advances received in the ordinary course of business are outside the scope of the deposits. However, prolonged outstanding advances without supply of goods or services or advances which becomes refundable require careful evaluation under the deposit rules. These are all important. Even security deposits received in connection with the genuine commercial contracts are not treated as a deposits. Nevertheless, every security deposit does not automatically qualifies for exemption. You have to see case-to-case basis. The underlying contractual agreement and purpose of the receipt should always be reviewed. What about convertible notes? Convertible notes issued by eligible startup enjoy specific exemptions only when the prescribed conditions are satisfied. Whether the stipulated conditions are not fulfilled, such receipts may require different treatment under deposit rules. Importance of proper documentation. Proper documentation is equally important as well proper classification. Company should maintain loan agreements, board approvals, directors' declarations, because the loan from director exempted when there is a declaration. It is a mandatory share application records to establish that is a share application money and supporting agreements for advances. Just like that, we cannot write there should be a document reconciliation with the financial statements. So these documents become important during regulatory inspections and compliance review. What are the consequences of incorrect classification? See, incorrect classification or incorrect reporting may have more serious consequences than delayed filing. If an amount that actually qualifies as a deposit is wrongly reported as an exempt receipt, the company may face action under the Companies Act relating to acceptance of deposit, very serious, section 76A. So company should ensure that each transaction is examined with reference to the applicable provisions before filing DPT-3. I'll give you a checklist before uploading DPT-3. Should verify, reconcile the outstanding loans as on 31st March. Identify each receipt with reference to Rule 2, Sub-Rule 1, Class C. Verify supporting declarations for director loans and review pending share application money. Examine outstanding customer advances and classification or treatment of security deposits. Security deposits, if at all there, and then cross-check balances with audited financial statements, or otherwise, if not audited, check with the auditors. Ensure all required attachments are complete. Verify the category selected in the form before submission. So do not rely solely on the accounting classification, and because our classification as for DPT-3 is different. Review every outstanding balance from legal compliance perspective. Obtain missing declarations before filing only you procure. Preserve documentary evidence supporting exempt treatment. In case of ambiguity is there, suppose, then obtain professional advice before final submission, since the form DPT-3 generally cannot be reviewed once filed. So additional care should be exercised while preparing the form. So DPT-3 is not merely a procedural annual filing, so it requires careful evaluation of every outstanding borrowing and receipt appearing in the company's books. So proper classification, adequate documentation and reconciliation with the financial statements are essential for ensuring compliance with the Companies Act 2013. Thank you very much. We have two channels, RR Corporates, other channel RR Legal Talks. Please do subscribe, hit the bell icon so that you will not miss my latest videos.